You're scrolling on real estate websites and you run across a listing, $475,000 with a 3.5% assumable loan. I think this is the property. Let's go for it. Hey guys, welcome back to the channel. My name is Alex Canals. I'm a top-rated home loan mortgage originator, and in this video, we're going to discuss all things loan assumptions. If you have any mortgage real estate related questions, message me anytime, and if you wish to get pre-qualified, all my contact information is in the description below. This is a real-world example, a very sophisticated buyer of mine, $475,000 list, and in the listing, it said, assumable loan, 3.5%, $142,000 balance. He called me, he had questions on the loan assumption process, and I kind of walked them through it all. Loan assumptions are the hotbed in our industry right now because rates are about 7%. And if you can get a rate of 3.5%, just assume somebody's loan, that would be a no-brainer, but it's not a no-brainer and it's not that easy. Here's how it all works. First and foremost, you have to be approved by the loan servicer in order to assume the loan. And then you have to make up the difference between the sale price and the current loan balance to assume the loan. $475,000 sale price, $142,000 loan amount, the difference is $333,000. So assuming he was approved for the loan assumption, he would have to come to closing with $333,000 to make up the difference between $475,000 and $142,000. Well, he unfortunately didn't have $333,000 lying around, so that was not going to work. A lot of listing agents go ahead and put loan assumption in the listing to get clicks, to get more people interested in their property, I get it, but very few people actually get a loan assumption. It's because coming up with the difference is a monumental amount of money. So myself and this borrower, we got really kind of in the weeds, breaking things down. How can we come up with $333,000? I was like, okay, we can also entertain doing a second mortgage on that property for the difference. Your first mortgage is the first lien. A home equity loan or a home equity line of credit or a second mortgage, they're the same thing, would be the second lien. A second lien carries a higher interest rate than a first lien because it's referred to as risk-based pricing. Second or third mortgage will have a higher rate than a first mortgage. Also, the rates are going to be higher on an investment home than a primary home. This potential buyer is looking to purchase this property as an investment property. So who knows if they'd even approve them because the current loan is an FHA mortgage, and who knows if the loan servicer would allow an investor to purchase and assume an FHA loan that typically requires somebody to be owner occupied. We didn't get that far because he didn't have $333,000, but back to the drawing board, how do we actually come up with the money? So I was like, we can always entertain doing a second mortgage behind the 142. Second mortgage rates on an investment property, they're appalling. They're probably between about 9 and 15%, and he would still have to come with 25% down because you can't do 100% financing. You can't do 142 assume their loan and a $333,000 second mortgage. That's considered 100% loan to value. That would not work on an investment home. The max loan to value is usually 70 to 75%. So he would still have to put 25% down on top of the $475,000 sales price, and then he'd be able to take out a second loan for between 9 and 15%. When we did the calculations, we looked at a regular purchase, $475,000 times 25% down, do a standard investment property home loan here, or we looked at do a loan assumption at 3.5%, a second mortgage at 12%, plus put 25% down. Drum roll, the standard mortgage ended up working better for him because he would be crushed with interest if he went with a second mortgage on an investment property. So the loan assumption didn't get us anywhere, but he had great questions. People see 3.5% loan assumption. They just think, okay, cool, I'm gonna put down a regular down payment. I'm gonna walk away with 3.5% interest. It does not work that way. So as you're searching for real estate, if you see a loan assumption in the listing, you have to realize that you have to get approved for the loan assumption from the loan servicer, and you have to make up the difference between the sale price and the current seller's loan balance. Generally speaking, right now, people selling properties have a relatively small loan balance versus the current sale price. A lot of people have got a lot of equity in the property, and it would be your responsibility to make up the difference. Average buyers do not have $333,000 sitting around on regular traditional single family homes. If I'm looking for real estate, and I'm running across a listing and it says loan assumption, and I may only have to come up with $20,000 or $30,000 down, it's reasonable. What I'm getting at, do not put your hopes in home ownership thinking you're gonna go ahead and get an assumable loan. You're gonna be looking at real estate forever, or the only loan assumption you're gonna find is gonna be on the other side of town. It's gonna be a rundown property. And also there's gonna probably be 50 other people looking at that same property with that same loan assumption. If the stars align and you find a house you like and you can get the loan assumption, then go for it. I'm not discouraging you from doing that, but don't put all of your eggs in one basket thinking you're gonna purchase real estate this year with a loan assumption. More than likely, it's not gonna happen. It's a clickbait topic in our industry. It's on the news, it's on websites, it's all over our listings. It's just not that easy to go ahead and just simply assume somebody's mortgage, and then all of a sudden you get the great rate and the great terms and everything is all hunky-dory. So I hope you enjoyed this video, and I hope it was educational, just giving you the lowdown with mortgage assumptions. I'll see you in the next video, and have a great day. Bye-bye.